Good afternoon, ladies and gentlemen. Good afternoon, ladies and gentlemen. Good afternoon, ladies and gentlemen. Good afternoon from the Marriott Eaton Centre in downtown Toronto. Welcome to the Empire Club of Canada. For those of you joining us on webcast or podcast, welcome to the meeting. Governor Poloz once joked that succeeding Mark Carney was like replacing the guy who followed Wayne Gretzky. It is hard to follow bright lights, but then it happens. After Wayne Gretzky came Mark Messier, who led the Edmonton Oilers to a Stanley Cup. Governor Poloz has certainly made a name for himself since taking over the reins of the Bank of Canada. He first joined the bank in 1981 and climbed up the ranks over 14 years. Then the Governor Poloz left to take on new challenges at Export Development Canada, and it eventually rose to serve as its president and chief executive officer. When the Bank of Canada tapped him to take over the top job in 2013, Governor Poloz was more than prepared for the task. Battling through the challenging times to reach steady economic growth, low unemployment, and inflation on target, Governor Poloz delivered a remarkably stable economy for Canadians. In his own words, the role of Governor of the Bank of Canada is a dream job, and he certainly made the most of the opportunity to live out that dream. It's clear that he will now also leave big shoes to fill. Ladies and gentlemen, it's my honor to welcome to the stage the Governor of the Bank of Canada, Stephen Poloz.
Well, thank you very much, Mike. That's a lovely introduction. I was sharing with Mike that I first spoke here at the Empire Club in 2003, and many people in this room were in high school at that time, so acknowledge that I'm kind of an old-timer around here, that's for sure. It's become a tradition for me to give a speech at the end of the year, touching on the major issues affecting the Canadian economy. Now, I only get to say this once, so I hope you're going to permit me to do so. Today, I'm going to focus on the bank's 2020 vision. Seriously, that's as good as it gets. Okay. All right. Okay. Got that out of the way. Anyway, I want to walk you through some of the major forces that are acting on the economy and indicate what the bank is doing about them. And I touched on some of these issues back in September when I was fortunate enough to speak at the Changing Fortunes Roundtable at Spruce Meadows in Calgary. And since then, what I've been doing is working to formalize some of those ideas in a paper, which the bank is actually publishing today alongside my speech. So in stepping back from the many short-term issues that the bank has on its plate, I can avoid covering some of the same ground that was in last week's speech by Deputy Governor Tim Lane. Now, Tim discussed the considerations behind our latest interest rate announcement and offered a really excellent historical analysis that put it all in context. So when we look at the global economy, The basic story since 2008 has been one of disappointing economic growth. We came to call it serial disappointment. And yes, it did prove quite difficult to recover from the Great Recession that followed the global financial crisis. But other long-term structural factors have also been at work throughout this period. Now, there's two basic factors that drive trend economic growth: population growth, productivity growth. Now, global population growth, well, that peaked back in the mid-1960s, and it has been declining ever since that time. So what that does is it puts a natural brake on global economic growth. Now, recent productivity gains have not been large enough to offset the impact of this demographic slowdown. Now, of course, there's potential for higher productivity growth in the future. Now, here I'm referring to what's been called the Fourth Industrial Revolution, the increasing use of artificial intelligence, AI, machine learning, big data throughout our economy. But judging from past experience, these productivity gains could be slow to arrive. Think back, computers went into widespread use during the 1980s when I was a young guy working at the Bank of Canada. But a surge in productivity growth did not emerge until the period from 1995 to 2005. I delivered a paper about that phenomenon just a few weeks ago at the conference hosted by the Federal Reserve Bank of San Francisco. Now, besides the near-term risks around productivity growth are actually on the downside today. This is because trade conflicts and the emergence of nationalist or populist policies more generally threaten to reverse some of the prior productivity gains that were made through globalization. Tariffs on imports are forcing companies to dismantle supply chains. And then they have to create new ones that are very likely to be less efficient than the old ones. And at the same time, uncertainty about the future of trade policies, and indeed of critical institutions such as the WTO, is having a much more insidious effect. Companies have cut their investment plans worldwide, which also means less potential economic growth in the future. On balance, then, it looks like the global economy is set for continued slow economic growth, and this is for mostly structural reasons. And for these same reasons, this means that the low interest rates we see are likely to persist also. Now, to be clear, I'm not making a near-term prediction about the Bank of Canada's policy rate. What I'm talking about is structural forces that are acting on the global economy and global interest rates over a period of years. In any era, interest rates fluctuate around a trend line. And that trend line is determined by structural forces, not by monetary policy. What I am saying is that in this era, it looks like interest rates are likely to fluctuate around historically low levels. Now, one possible consequence of persistently low interest rates is that household indebtedness may continue to increase relative to the overall economy. Government indebtedness might also continue to rise as governments try to kickstart sluggish economies. The world's stock of debt of all types today is more than 3 times global GDP. Now, experience shows that high debt levels can amplify the impact of a shock on the economy, such as a rise in the unemployment rate. The reason for that is that some borrowers might default on their debts, which of course would lead financial institutions to lend less or even fail. In the meantime, governments with a high debt load may be less able to stimulate a faltering economy. Now, here in Canada, household indebtedness is our most important financial vulnerability. The latest data show household debt is 177% of disposable income. Now, that's a bit below last year's record high, but it's still elevated. Now, for some countries, it's the stock of government debt that causes the most concern. U.S. government debt is now more than 100% of GDP and rising very quickly. In Japan, government debt more than 200% of GDP. Now, in comparison, Canada's total government debt is close to 90% of GDP, of which federal debt is around 30%. Now, policymakers have taken the lessons learned from the 2008 global financial crisis to heart. They've imposed new rules on banks around capital, around liquidity, and the global financial system is far safer today as a result. Here in Canada, authorities have also imposed stricter guidelines around mortgage lending to help contain financial vulnerabilities. And thanks to these changes, even if household indebtedness rises further, its sustainability is gradually improving. Now, in contrast, the lessons of the great inflation of the 1970s seem to be fading from our collective memory. Perhaps the recent tendency for inflation to run below target in many countries has fostered a degree of complacency. Or more likely, inflation risk is being overwhelmed by deep structural forces that are limiting economic growth, keeping even long-term interest rates very low. Now, I agree that the risk of a surprise outbreak in global inflation is low. But it seems to me that the combination of elevated household and government indebtedness and populist politics holds inflationary potential for some countries. Some leaders are even actively questioning both the value of inflation targets and the need for central banks to be politically independent. Highly indebted households might be inclined to vote for politicians proposing to promote higher inflation. The fact is, the great inflation of the 1970s resulted in a substantial transfer of wealth from savers to borrowers, including to governments. Now, fortunately, we have an institutional framework here in Canada that addresses this risk directly. The Bank of Canada and the federal government agree formally and transparently every 5 years on the goals of monetary policy. This gives our inflation targets democratic legitimacy while providing the bank the operational independence to pursue them. Importantly, Canada also maintains a flexible exchange rate, which is essential to maintaining low and stable inflation domestically, regardless of developments abroad. Now, given this backdrop, you can imagine a veritable smorgasbord of work will be going on at the bank during 2020. But let me focus on 4 areas. The first is the inflation targeting agreement that I just mentioned. The next renewal of the agreement is scheduled for 2021. And the bank uses the time in between renewals to take stock of experience with the framework and to look seriously at any improvements that we can make to our monetary policy. Now, there's a section on our website where you can follow the current renewal process. Here we are posting new research as it is completed and providing information on workshops and conferences that are dedicated to the topic. In this renewal cycle, we're going back to basics, comparing alternative targeting frameworks, such as inflation averaging strategies, nominal GDP targeting, with inflation targeting. We're also researching the various tools we have at our disposal and how our policies interact with other public policies. Moreover, we are expanding our efforts to gather outside views on these issues. We've been talking to a wide range of stakeholder groups, including business and labor organizations, academics, and of course, other central banks. In 2020, we plan to hold a number of roundtables with civil society stakeholders to deepen our understanding of the economy across sectors and regions. As an accountable public institution, we're eager to hear your views. And that's why in 2020 we'll conduct an open public consultation process on our website to gather input from Canadians across the country. And we'll summarize these public and stakeholder consultations as well as our new research on the subject on our website in late 2020. We'll then make a recommendation to the government and hold discussions that will lead to the next formal agreement on the framework in 2021. Now, another important area for the bank next year will be to continue to embed financial stability linkages in our monetary policy framework. Now, let me illustrate this with an example. So consider a situation where we updated our economic forecast and we concluded that inflation was likely to move below our target. Well, our models would suggest that we should lower interest rates to stimulate economic growth and bring projected inflation back up to target, usually over a 6 to 8 quarter horizon. Now let's consider exactly the same situation, but where there are high levels of financial vulnerabilities in the economy. Stronger economic growth from lower interest rates would make it easier for everyone to service their debt. But lower interest rates would also encourage a buildup of new debt, making economic growth more vulnerable to a future shock to the economy. In turn, this could make it harder for us to achieve the inflation target sometime in the future. So accordingly, bringing financial vulnerabilities into the equation means introducing a degree of flexibility into the inflation targeting process. The horizon over which we would work to get inflation back to target depends on the severity of the financial vulnerabilities. And of course, to the extent that macroprudential policies, like mortgage rules and so on, are in place to keep financial vulnerabilities in check, then policymakers can put less weight on those vulnerabilities. Now, over the past couple of years, bank staff have developed a new framework to help us objectively evaluate this trade-off. It's called a growth at risk model. Now, it combines the risks to economic growth and inflation coming from both the macroeconomy on the one hand and financial vulnerabilities in any given setting. It requires a lot of judgment to use this, but the framework is helping to bring more rigor to our deliberations and to our communications. The growth at risk framework that we're using today is basically a prototype. It's based on international experience with financial vulnerabilities, and it's based on a very simple macroeconomic model. So work to enhance the model and incorporate more Canadian detail into the financial vulnerabilities is well underway, and these enhancements should be deployed in 2020. Meanwhile, we'll continue to refine our core economic forecasting models to enrich the linkages between the financial sector and the economy. And we've also begun to scope out work, a whole program of work really, on the next generation economic model that would replace our core structural projection model, which today is called TOTEM. Judging from past experience, that effort could take up to 5 to 10 years to complete. A third area of focus for the bank in 2020 will be to assess the economic and financial impact of digitalization. Now, as I mentioned earlier, we can see all kinds of evidence of the spread of artificial intelligence all around us. Its effects on the economy may be profound. My main message in San Francisco was that the fourth industrial revolution will probably follow the pattern of the previous 3 industrial revolutions. We can expect a significant disruption of workers in many industries. We can also expect the new technologies to lead to stronger growth in sectors where they are deployed. And the higher productivity that will result will increase the economy's potential to grow. This growth, in turn, will create new job opportunities throughout the entire economy, while also causing inflation to fall a bit short of what our models would predict. So that summarizes the experience in the first 3 industrial revolutions. So far, we haven't seen signs of higher productivity in the economic data. Now, once again, the experience of previous industrial revolutions can be instructive. In the last few years of the 90s and early 2000s, we now know that productivity rose quickly. But the economic statistics of the time did not capture this until long after the fact, precisely because it's difficult to measure developments in brand new economic sectors of the economy. So it's certainly possible that the same dynamics will emerge again in the near future. In 2020, the bank will be working hard on new ways to detect and determine the economic impact of the fourth industrial revolution. One area that shows promise is to use AI to analyze big data, text mostly, for keywords, and to build synthetic indicators of technological change. So a local woman, Michelle Alexopoulos from the University of Toronto, and a winner of a Bank of Canada Fellowship Award, is doing very innovative work in this area. And of course, we'll also talk directly to Canadian companies to gather intelligence on the spread of AI. So fourth, there's the central banker's favorite subject. Everybody know what that is? Money. Well, technology is affecting how Canadians make payments. So, of course, it's going to affect money. Now, to start with, Payments Canada is working with the bank and with the major financial institutions to modernize our core payments systems. This is going to allow for wider access to the systems and more innovation. The first stage of this work is to replace the wholesale system, which is now over 20 years old, which manages transfers between major financial institutions and through which the Bank of Canada operates. Now, most of the work on the new wholesale system should be completed in 2020. Now, the wholesale system handles most of the dollar value of our payments every day. But there are thousands of times more retail transactions on any given day. So modernizing the retail payment system is a top priority. So roughly 2 to 3 years from now, you'll be able to execute transactions between yourselves in real time. That's a major advance over today's lags in the system. Now, these prospects have the bank thinking hard about the future of money, especially cash, which is really my favorite. So a decade ago, more than half of all transactions in Canada were done with cash. And today, that number has dropped to about a third. Still a lot. But it's more and more common to see people tap a card or take out their phone to make a payment. And of course, Canadians are also doing more business online. And more than half of us have sent money with PayPal or Interac e-transfer. Certain businesses have begun to accept only electronic payments. Now, I believe that central bank money, the banknotes that you have in your pocket, will always provide an important public good. That's an individual's sovereign right to make payments with an instrument that is universally accepted and final. Now, a private digital currency cannot deliver that, regardless of how innovative or widespread its use becomes. I mean, the other nice thing about cash is that it will still work even during power blackouts or cyber attacks. As a consequence, banknotes will probably always be around to some degree, if only as a contingency for unusual events. All things considered then, to me it's an open question whether the Bank of Canada would ever see the need to issue a currency in a digital form as a substitute for cash. But the world of money is evolving very rapidly, so we need to develop plans to deal with whatever contingency does arise. And we'll have a lot more to say about this early in 2020. So given this context, the bank needs to think about other emerging payment technologies. These, of course, include crypto assets, such as Bitcoin, as well as stable coins, such as Libra. And because these are potentially global, they're attracting attention from central banks and other regulatory authorities. Such innovations bring innovations, but they also bring new risks to the financial system. And we need to understand these risks and apply appropriate regulation to them. So one area of particular interest to central banks in this regard is cross-border payments. So, as usual, the bank will be working on many more issues in 2020 than I've been able to summarize here. But before I conclude, let me mention one topic that has garnered a lot of interest lately, and that's modern monetary theory, or MMT. Now, essentially, the idea is that governments can issue their own currency. Governments that can issue their own currency can never go bankrupt. Hands up if you think that's correct. Excellent. But that's the idea. Accordingly, rather than borrowing from the public by issuing bonds, governments should spend as much newly issued money as is needed to keep the economy growing and maintain stable inflation. Now, to me, this sounds like MMT is offering the proverbial free lunch. And I think most of us know there is no such thing. Now, first of all, MMT, it's not monetary. Government spending, that's a fiscal decision, not one for the central bank. Secondly, it's not modern. It's been tried many times in the past, and the record is not pretty. For example, in the late 1960s, the US government was running large fiscal deficits to finance the war in Vietnam. And this led to very rapid money creation. The result of this was a breakdown of the Bretton Woods system of fixed exchange rates and a surge in global inflation that spanned the 1970s. Now, frankly, there are far better means of avoiding slow economic growth and deflation. Examples: promoting innovation, providing infrastructure, removing impediments to international trade, removing impediments to intra-national trade, i.e. interprovincial trade, eliminating red tape. These are the simple examples, just to cite a few obvious ones which would prove to give us stronger trend economic growth. So with stronger trend economic growth, fiscal and monetary policy can focus on their real job, which is to buffer economic fluctuations. Well, it's time for me to conclude. We can see the broad forces of low interest rates, rising debt, technological change working in combination to bring stress to households, companies, and governments. The impact of these forces will keep the Bank of Canada busy in 2020 and, of course, beyond. And the precise way that these forces will unfold remains highly uncertain. All of us, consumers, business people, policymakers, will have to deal with these sources of uncertainty over the long term. Now, I know that sounds challenging, and I won't pretend otherwise. But when you consider the broad sweep of history, you have to admit that Canadians have always had to deal with powerful global forces and uncertainty, some far more potent than the ones we face today. And yet here we are. Here we are in a thriving modern economy. Tout n'est pas rose, c'est sûr. Mais pensons à ce que nous avons traversé en 10 ans. Et malgré tout, l'économie canadienne tourne presque à plein régime, l'inflation est à sa cible et le taux de chômage est presque à un creux historique. I'm not saying to you that things are perfect. Far from it. Sectors and regions of our country continue to struggle, and policymakers have lots of work to do. Still, consider what we have been through over the past 10 years alone. The global financial crisis, the subsequent slow recovery, a collapse in oil prices, political uncertainty abroad. And despite all of that, Canada's economy today is operating very close to its capacity. Inflation is on target. Labor force participation is up across almost all age groups. And the jobless rate is near historic lows. Now, in my experience, one should never underestimate the ability of Canadians to face and overcome challenges. using exactly the same tools that they always have, and that's hard work and ingenuity. So I wish you all the very best for 2020. Thank you.
Thank you very much, Governor. You've agreed to take a few questions, so there will be a mic moving around if anyone has a question for the Governor. But I'm going to start by you shared a nice little story here. You talked about cash in your speech,
Yep.
and you talked about your signature on day one.
Oh.
And that's not a story that they might expect, but I think it's real interesting if you could share this with the group.
Okay, so that's your question, right, Mike?
That's what I'm starting with.
Okay, because Mike promised to pay me $1 for every question that came from the floor. So let's see the lineups. I want to see that. All right, so, well, the story was, yes, because he was asking me one of the high points, and, you know, the first day on the job, someone came to my office with a sheet of paper, with heavy paper with 10 boxes on the paper, and a special pen, and they asked for my signature. And I had to sign 10 times, once in each box. And then when we were done, I got to choose the one I liked the best, and that became the signature that went on the money, which is a pretty big deal for an economist, a lad from Oshawa, right? But anyway, just before I did it, I said, okay, I just want to warn you, I'm going to sign my full name. Oh, no, you can't do that. Well, what do you mean I can't do that? No, you can only use their initials. All the governors in history have only used their initials, okay, not their full name. Well, I'm going to use my full name because, yes, of course, Poloz is my family name, but Stephen is my mother's family name. Okay, so it's two family names. I want them both on the money. Sorry, Governor, you can't do that. No, I'm going to do that. It's going to make it too small. I don't care. No, Governor, you can't do that. I'm sorry. They just made me the boss of you. Okay? So I'm going to do that. And that's the story of why my full signature is on the money.
Thank you very much. We have a question over here.
Hi, Stephen. Ziggy Krupa. Can you elaborate a bit on the negative rate environment?
The negative rate environment. Yeah, well, there's no question that this long cycle since the global financial crisis has been very challenging for central banks and governments. You know, many countries kind of, I guess, got serial disappointment on growth. And wherever we get a little bit of momentum, then it seems to falter again. And so monetary policy in most countries got pushed to its very limits. There really nowhere else left to go. And so it became, what became a theoretical possibility became a reality as some countries pushed interest rates below zero. We've done some analysis out of ourselves. I mean, I gave a speech, I think, in 2015, outlining, how we thought about that tool. Then roughly around minus 0.5% is when people would start to convert all their deposits into cash and buy a safe or whatever they would do with it to put it in, and because then the costs associated with carrying that much cash, are roughly on that sort of half a point. And so that just means that interest rates could go below zero and still have an expansionary effect on the economy. And of course now it's not theoretical. We've had countries that do it, have done it, and are still doing it today. Interest rates are a relative thing. So it definitely has some additional effect on the economy. I've said before that when your interest rates are that low, what you're really trying to do is encourage households to borrow, to buy some more houses or cars, right? And that, of course, creates a bigger pile of household debt. So you could instead, as a society, decide, well, it would be okay to have a bit more government debt instead. I mean, debt is debt. Does it really matter which pile the debt is in? Something to think about, but the point is that you could use fiscal policy, accumulate a bit more government debt while accumulating less household debt, and that mix would be probably easier to manage. But that's a bigger problem than what central banks can address. We just go into it today with a more informed view than we had when it all began 10 years ago. We all hope that it doesn't last a long time. That's for sure, that that it has its effect, and then you can get out of it and get something more normal, better for your system, for sure.
Perfect. I think we have one more question over here.
Only 2 questions, really? That's $2.
Somebody's getting $2. About a year ago on this very stage, the president of CIBC had spoken, and his main message at that time was highlighting the unprecedented amount of money leaving the country and the historically low levels of money coming into the country. I guess my question is, are we doing enough to correct that trend?
Well, okay. At first, I would just want to adjust the premise a little, because those data have actually turned around, and this year, foreign direct investment into Canada has picked up well. But in that background, of course, we've had weak investment, period, in Canada. In fact, now we have weak investment in most of the major economies because of the uncertainty around the future of the trading system, and, am I going to put a bunch of money on the line and then have some trade policy ruin my business proposition? Okay, so that uncertainty has frozen a lot of people. And so, but in our case, it's primarily, if we go back to the collapse in oil prices in 2015, meant that today investment in that sector of the economy is running about half of what it was before that. And so that's not just domestic companies investing less, it's of course foreign companies investing less. And so everybody's investing less in that sector. So that's the primary reason why we observed that trend during that period. That, I think, is at its bottom. I think what we're seeing is signs of renewed investment, and of course companies have adjusted their cost structures so that they can make money at lower oil prices than before. And so that resets all of those kind of decisions. But more importantly, beyond that story is the broader space of investment, foreign and domestic, has been doing better. So it's lower than we predicted still because of the uncertainty around trade, especially the NAFTA renewal. But we're hopeful that that will begin to return back to its old trend line once NAFTA is truly ratified. It's a good positive that's on our horizon, which I think we should take heart from. And the foreign direct investment has, in the background, picked up well, even in the manufacturing sector. So it's not just in IT, and which is our fastest growing sector today in the Canadian economy. Is growing by about 8% a year, the IT services sector. It's the fastest growing job category and the fastest growing export category, and it's leading much of the growth that we see in the service sector. About half of the economy is growing quite solidly. The other half of the economy is slow or around zero. So the average, as you know, is pretty close to 2% or a little less than 2%. So there.
Well done. Maybe one last question for me
Okay.
before we wrap up.
See, as soon as I mentioned that dollar thing, it got people worried, eh?
Yeah. Maybe if there's one part of the Canadian economy you think is generally underappreciated that doesn't get the attention it deserves.
Well, actually, I think the one I just mentioned is an obvious example. So, IT services, you may think it's just the folks that manage your, come in and fix the problem or whatever. But it now is over 5%, 5.5% of the Canadian economy. So it's bigger by itself than many, many other sectors that you could name. So that's pretty important. And as I said, growing at, they say, 4 times the average growth rate in the economy. And that's because we have such great schools and a great emerging workforce in that space. And by the way, exports connected to this is exports of education services. It's a very strong category for us. And that's buried in a thing we call tourism in the statistics. But it's a very rapidly growing category. and something that we should continue to invest in, because it's not just for our kids. Okay, it's a fantastic engine for us to grow a highly qualified workforce from abroad. And as I said, demographics are the key to growth. Well, Canada will stop generating new members of the workforce in the next 4 or 5 years. All of our growth in our workforce will come from immigration over the next 4 to 5 years, and then it'll be only immigration fueling our economy then. So I think the university door is the best way for folks to come in and start a new life and a new career. Hopefully some of them stay, and then we get these fabulously qualified people. So anyway, there's an answer for you.
Thank you very much. Governor Poloz.
Thanks, everybody.
I'm now going to ask Trevor Townsend from Canaccord Genuity to properly thank our speaker.
So I'm very pleased to be the sponsor this afternoon at this event here at the Empire Club. Special congrats to you, Mike, and to the team here with the Empire Club, and the caliber of speakers that you bring into this room every month, in particular this afternoon with Governor Poloz. Having worked personally on Bay Street for the last 25 years, I've long admired the caliber of the public servants who step up to sit in the chair of Governor of the Bank. I think back to some of your predecessors with Gordon Thiessen and David Dodge, of course Mark Carney, and now Governor Poloz. Governor Poloz, you discussed this afternoon the many challenges of finding that responsible balance in what is a complex and ever-changing world. And we look at at this vast country, both geographically but also economically, and the challenges that you've had to deal with. You spoke about the unprecedented, in the energy market with the unprecedented volatility that we've experienced there, and one looks to the devastation right now in Western Canada that they're still dealing with. One looks to here in Toronto, here in Ontario, at the unprecedented surging housing market, and the prices here in our own backyard, and the affordability of living in this city becoming more and more challenging for so many people. In my industry, in the investment industry, we look at the equity markets, the climbing to all-time highs. We also look to as you spoke to the climbing consumer debt. Indeed, the challenges that you've experienced and worked with over the last 7 years have been unprecedented. So I thank you for that, and I thank you for your presentation this afternoon. Certainly, when one listens to your comments, I think we can take away that the chairmanship, the governorship of the Bank of Canada has been in good hands. I'd like to present you with a small token of our appreciation, which is a bottle of whiskey barrel aged maple syrup that you can hopefully enjoy in those cold Ottawa Saturday mornings. Thank you very much.
Well, I'm just going to let you know that there's a number of other events coming up at the Empire Club of Canada. Tomorrow we will present our inaugural Nation Builder of the Year award to the Toronto Raptors. We have our Investment Outlook event taking place early in January. On a day when we all learned the news that Andrew Scheer has stepped down, I can tell you that we happen to be having the Ontario Liberal leaders who seek the Ontario Liberal leadership are going to have a debate. That event will be announced soon, and that comes on January 15th. Thanks, everyone. This meeting is adjourned.